Good morning and welcome to the Orlando Real Estate Buzz. I'm Brenden Rendo with the Homes in Orlando team of Next Home Neighborhood Realty, and joined as always by Joseph Dionne of Aptly Home Loans, the mortgage guru.
Good morning.
Yeah, nice kind of quiet morning this morning, but
A little bit.
a lot of stuff going on. So we had Trump have his cabinet meeting. Did actually spend some time on housing. We're going to take a look at that. Don't know how he's going to do what he wants to do. We have our new nominee for the Fed, Kevin Warsh. Interesting difference between him and Powell. So it's going to be interesting to see how that affects interest rates and stuff. And then we've got some news on Florida home values overall. So there's a lot of stuff we got to cover today. So thank you. And of course, welcome to the Orlando Real Estate Buzz. So Joe, I thought we would start out with President Trump at the cabinet meeting and the dichotomy of what he's trying to do was interesting.
What is he trying to do? What is he trying to do? Come on.
Well,
Housing, because in my opinion, I have very strong opinions on housing. That's what I did for a long time. I did good with it. But, we got to get interest rates down even lower. They are now pretty low, but we got to get them lower. And I'm a big factor. To me, the biggest factor is interest rates for housing. Only in that, you have a lot of people that have become wealthy in the last year because their house value has gone up. And, when you get the housing, when you make it too easy and too cheap to buy houses, those values come down. I don't want those values to come down. We have millions of people that own houses, and for the first time in their life, they're wealthy because their house is worth $500,000 or $600,000 or more or less, but more money than it's ever been worth before. I don't want to do anything to knock that down, and so I want to be very careful with this. You make housing, I can turn on housing immediately, but you make it too easy and you're going to knock the value down of people that own houses. I want to, for those people, those millions of people that own houses, we're going to drive those values up, but we're also going to try making it easier for people to buy. The best thing that can happen for both groups of people is lower interest rates, and those interest rates are coming down, and with a proper, intelligent person at the Fed, that person will be able to work with us to get interest rates down. That covers all of the sins. It covers everything. Lower interest rates keeps the values up for the people that have housing and lets other people buy housing. And Scott, if you could just.
So that, I don't know how you do that, because what he's talking about is keeping values up, keeping values increasing, but making it more affordable by lower interest rates. Well, what happened the last time we had real nice low interest rates to home values?
I mean, it drove values even higher.
Yeah.
Which impacted affordability. I get it in the perfect world. If value doesn't change and rates go down, then that home becomes more affordable. But we know that if it becomes more affordable, it might drive up demand even more, which would typically, we have case history, we have recent history of this.
Yeah. And I think what we end up doing is we end up having a stale market like we have now. We're just creating another market that's going to be stale longer because we've drove the prices back up, because you're artificially decreasing the rates. So, it's like sometimes I know everyone wants a quick solution. I think that's part of the problem with the world today. Everyone's looking for that 10-second, or 30-second Instagram solution of how to fix something. Sometimes you just got to let the market play out. You look at the way things are going, currently, the income, people's income is increasing at a greater rate than inflation is right now. So is that helping people? Yes. And then you look at other items, like here in Florida, this is something that you don't necessarily want to see, but it's true, is, Florida homeowners last year lost a median of about $10,000 in home values last year.
Yeah.
And we've mentioned, multiple times that, hey, home values are coming down. And there was a report out yesterday too that people's equity has shrunk a little bit, not a whole lot, but a little bit.
Mhm.
So to me, this is just the natural market doing what's supposed to, is finding a balance of, an equilibrium based on incomes, based on interest rates, based on everything else. Because I mean, interest rates right now actually are not at bad rates when you look historically.
Yeah, historically. I mean, recency bias, it becomes like they look horrible, but and that's the hard part, is it's hard to be like, hey, like, well, go back to the 90s or the 80s or the 70s. Like, there's a lot of people buying right now that weren't alive when so it's hard to say that from a historical, but it is, the reality is it's, the norm, like the normal wasn't 3% or 4% that some people saw. And now they're like, why isn't that it? Like, well, no, that was the normal. That was a blip.
Yep. And, when you talk about another blip is, we mentioned this, I think, last week about the difference in migration to the state of Florida. And here's, if you look at it, my gosh, during the pandemic, we gained nearly, 500,000 people during those years. This past year, we had a net increase in migration of only 23,000 people. That's a lot less people looking for houses. It really is. So, yeah, is that going to be a factor? I mean, I think there's a couple things, and I saw Secretary Bassett talking the other day, with the crackdown on the border and stuff like that. Those people who needed homes are not in the market, quote, either. So we've pulled them out. People aren't moving as much. So yeah, it's going to cause a little bit. It's going to create a staleness to the market that we haven't seen, in several years. So there's a lot of factors going on with it overall. But then we got, looking at the new gentleman, the nominee, Kevin Warsh. He seems to me like he's, I'm not sure what to think, because, I did a little research on him. Some of the stuff I found out about him is, Harvard graduate. So obviously very smart. Was the youngest Fed chairman at 35. That's pretty amazing.
He's 55 now, so 20 years ago.
20 years ago. Yep. But he resigned, and resigned because of the quantitative easing policies back in 2011. And he's been very, very vocal about Powell's quantitative easing programs that are going on currently. This is a quote from him: "The Federal Reserve's current regime is failing the real economy. We need a fundamental shift in how we measure success and a return to a rules-based clarity." So I'm not sure how to take that, but when you're looking at how people look at him, they looked at Powell as a data-dependent person. He's always looking at the data. They keep saying he's going to be a regime reformer, and that he's actually much more hawkish than Powell was. So if you're hawkish, doesn't it mean to you that you're going to be less likely to adjust rates? That you're going to
very interesting, right? Because wasn't part of him, and like he believes that rates should be coming down further, right? Warsh is saying that, but typically hawkish stance is going to be very, very conservative with a lot of this.
Yeah. His point is that with AI productivity increases, he feels that inflation can be controlled. And I'm like, I'm not feeling that. So,
okay.
but he, as far as, one other area, he does not like quantitative easing, does not like it at all. And he doesn't like the current balance sheet, the way that's set up. And, we had the highest balance sheet on the Fed that we've seen under Powell. We have dropped it, some about $1 trillion, I think, something like that. He wants to see this gone. And I'm like, I'm not sure how you're doing that, but he's talking of a tighter Fed Treasury relationship than we've seen over the past 20 years. So there's definitely going to be some changes coming with this if he's nominated, which everyone seems to feel that he's fairly solid, going to get going to get approved, and is going to be the next Fed chairman. But then you got Trump keeps pushing for lower interest rates. So if he's hawkish, I see too much. I see a lot of contradiction. I'm not sure how that plays out. If that makes sense,
You got a good point there. It is going to be. This is a very intelligent guy. But I felt like it was a little bit of a surprise for me from Trump for the pick. Like I didn't have Warsh high up there or anything. I know a couple people had him, but he's an interesting person because he is very educated, very smart. Served previously in the Fed. Wants to do this. He's very system structured in how he wants to. He wants to get rid of the balance sheet. He wants to do all of that. But then I can't help but think, and I'm just like, and I know this sounds silly. I was like, well, you take someone that's married to the heiress of the lauder, the cosmetic fortune.
Yeah.
And I'm like, well, is there are we going to see some decisions made that maybe help business a little bit like that? Like, or is there a way? Is this role where does it does it play? Because you can't help but think there's gotta is he the best person for the Fed? Where is it? And he's I don't know. I'm a little spun up on this one, and it's very easy to be hawkish when you yourself aren't worried about
Yeah.
Does that make sense?
Yeah. Because the way they're trying to spin him is that he's not Wall Street friendly. He's an outsider Wall Streeter.
Yeah.
It's like, well, how do you do that? And I agree with you. It's like he, 50 at 55, does he really need this position? Which I think is one thing you look at, and it's like, well, no, he doesn't really. But I'm just torn right now. I'm not sure where it's going to go, how it's going to affect housing, because you look at different things going on, and the U.S. government last week put out nearly $750 billion of bonds in auction, which is huge.
Wow.
But the bigger thing is when you look at what did they put out, it was all short-term bills. I think 75% of it was short-term bills.
Yeah.
So why are they doing this? Got me thinking, why are they doing this? Are they doing this because they know Warsh is coming in and he's going to have he's going to force rates down immediately, and then we can refinance these short-term bills to lower rates longer term?
Mm-hmm.
These are the things that I sit and think about, and you're kind of like, it's like, what? I'm always trying to figure out the why behind it. And sometimes I don't know.
Yeah. We don't.
You just don't know why they're doing things. But you're looking at all this stuff, and it's like, okay, how our focus is how does this help? How does this help real estate here in 2026?
Mm-hmm.
And we've seen 10-year holding pretty steady. My gosh, between 4.25, 4.3 for months now. The interest rates really haven't moved hardly at all. The one thing we did see,
they went up a little bit and market adjusted.
Yeah. What we did see over the past couple weeks is that mortgage applications have fallen. Last week they dropped 8.9%, and the week before that was about an 8.5%. So we had, beginning of the year, you had a nice little jump in mortgage applications. I think it made a lot of people feel good, like, oh, maybe we're over that barrier. First of the year, people want to, people are ready, holidays are over, let's go out, let's start shopping for homes. And I know the weather definitely was a factor. I mean, when 3/4 of the country was shut down, no one's going to go out, even though you can do it online now. No one wants to go out house shopping in 0-degree weather. Here in Florida,
we're worried about keeping
below
warm.
40. No one wants to do that, which I understand. So I think it's going to be important to watch over the next couple of weeks. If these numbers start to rebound. I mean, I don't think rates really are that bad. We're sitting a little above 6 right now.
Yeah.
Which
somewhere. Yeah, right there. 6 and an 8, somewhere in that ballpark. I mean, if we see pricing today, like markets move. I mean, you're talking the 10-year T is down 7 bips right now. That's a big movement today.
That's a big move.
MBS 30-year, the 5 coupon is up 24 basis points as of this moment, which means that we could see us getting closer to that 6 mark, that 6% rate, if it holds. But again, we don't like volatility. Like markets don't like volatility. So when you have days like this, it takes a little bit of consistency before we see it really pan out in the term of what consumers see.
Yep. I think one of the biggest concerns we have, and we've watched over the years, is commercial mortgage-backed securities, because usually commercial is a precursor of what's going to happen in the residential, and residential usually lags about a year, and we've got the highest rate of commercial delinquencies on record at 12.3%. So that's a little scary, because you got to remember, a lot of the regional banks are the ones who back these. Those and the private equity companies like BlackRock. I mean, everyone's worried about BlackRock buying residential properties, but I think the BlackRock shareholders are more worried about whether or not they're ever going to get their money back. I mean, they're big. One of their big funds, they dropped the value by 19%.
Holy cow!
Which is huge. And then you've got another private company, Blue Owl, which has dropped their share value has dropped 49% in the past year. And this past week, I think it dropped like 10 or 15%. So you've got the private equity guys, which are also the ones who are lending money to a lot of these commercial properties because they can't get it through banking. A lot of these hedge funds back a lot of the companies that do like the flips and things like that as well. So you're seeing a lot of these private equity funds, their shares and their balance sheets really start to get out of whack. So underlying, there's some problems out there that need to be addressed.
Yeah. You look at that and you think, like, you see all of that, and then you can't help but look at gold tumbling, silver tumbling, Bitcoin tumbling, Bitcoin tumbling, stocks like you're seeing the tech sector is selling off like hardcore lately. I'm very interested. I'm not saying we're in a state, but could we be looking at entering correction territory in the near term when it comes to stocks and equities? Like, it's very interesting. That's a 10% decline. Like, we're nowhere near that right now but again, it's so volatile. But I think
So volatile.
what I've noticed is we're starting to see consistent days down, not the other way around.
Yep.
So it's going to be interesting to see what happens.
Yeah. So it just, watching the markets. The one thing I am happy to see is the Treasury has been consistent, really, for pretty much the last month. So if you can get beyond all that noise that's out there, all the, like you said, the highs, the lows, you know where you stand as far as mortgage rates. Hey, the home I can negotiate more. I mean, one of the big things that that we saw was just one second. This has been interesting. Is the typical homeowner right now who's buying, on average, is getting about a 7.9% discount off the original list price. And we go through these numbers every week here in Orlando, and that's pretty darn close to exactly what we see. Is we're about what, 8.5 here in Orlando?
Yeah.
So if I'm a buyer right now, before the spring market hits, I'm thinking I may jump in a little early, simply because I think I can negotiate a better deal. Because I expect this to drop, 2 or 3%, once we hit the spring market. So then when we get back into our Orlando numbers for the week, pretty steady, but nothing exciting. We 357 sales this past week. The median single value of homes actually jumped. We back up over 400,000. We had dropped last week to below for the first time in a number of months. Inventory, decreased by 23, nothing major. Condos still sitting around that 100 mark. I mean, that has been fairly consistent for almost over a year now. But the price, this is interesting. The median price decreased by 9.3% to 244,900. So you're seeing those prices, condos are I'm seeing a lot of different types of incentives out there right now. There's a number of sellers. I think I saw this on 2 or 3 listings the past week, where they're offering paying 6 months worth of the HOA fees up front.
Okay.
To sell the condo. And I'm like, that makes a lot of sense, because one of them was in the Springs right here in Longwood, and you're looking at $953 a month for an HOA fee. So even if you're paying 6 months, I'm not sure I want that $953 monthly fee at the end of the 6 months.
I mean, that's a big one. The affordability of that condo is not there.
No. I mean, you're seeing a lot of these listings, where a year and a half ago, they were listed 225, 235, that area. They're being listed at $150,000. And they're still not selling. That's the amazing part. They are still not selling. So we drop into our numbers, months of inventory, still sitting above that 5. Original list, the sales price, here you go. We're what? Is that 8.5 or 97? Just over 7.3%. So we're pretty close to the national average of original list to sales price here in Orlando. Yeah. And then your $1 million plus homes, they're still sitting at roughly a 10% discount off of the original list price. And look at the months of inventory there. You're at 9.5 months. So if you want to sell quickly, you've got to adjust your numbers, to be more aggressive, to really go after it. And our days on market jumped a little bit, jumped about 10 days overall from last week. Then graphically, you see here it is, this average line had stuck above 400 for most of last year, and we're sitting now more like 350. Man, we need to get them pushed up. We need to get them driving. And I don't see any real big solutions out there besides time, right now. Total actives, we pushed back up this week, leveled off. I think some of that actually could be the weather here too, because I know I've got one coming in Apopka, and we've got some repairs to do, and we some of it was exterior, replacing a couple windows, things like that. And it's like, we're not doing it this week. The homeowner's like, I'm not opening up my windows this week. I'm like, okay, that's no problem. So we're taking care of that next week. So a little bit that could be weather as well.
Yeah.
And then our condos, look at that, almost 10 months of inventory. That is just a huge amount of inventory. And average days, 106 days on the market. So overall, I mean, we just continue, we're moving along, but we're not really popping, just not popping yet. And I want to feel it popping again. I want to feel the market pop again. So, but hey, I meant to bring something up earlier because, of course, we got the Super Bowl this weekend, right?
Yep.
Okay. Redfin's doing a commercial, right? And they're doing a contest. So the contest, they're going to give 6 clues over 48 hours. You have to go to the application and register your application, on their mobile app and stuff. And they're going to give 6 clues over 48 hours, and they're going to give away $1 million house. Okay. And I thought, well, where could the house be? So I put into Gemini, show me the places where the house is most likely going to be, based on current home prices. So here's a little cheat sheet for you guys, where to look for the house. Okay. California, forget it. It's not going to be in California. The average prices are way too high. Could be in Portland. Not feeling it. Right. Boulder, Colorado, average price is $1 million right now. So kind of, you want to throw out Denver, Boulder area, right?
Okay.
Salt Lake, Phoenix, the average price, good chance there. The best place where it might be is actually in the Midwest. When you look at Kansas City, Cleveland, and St. Louis average prices, I thought this was really interesting. Kansas City is only $337,000.
Wow.
Cleveland's $250, St. Louis $235. All right. The South, Atlanta, it'll get you about a 5-bedroom house, roughly. Nashville, get you a high-end designer home, right? Austin, Texas, I think will get you a real nice house because their prices have dropped, significantly. So, based off of what we're looking at, Manhattan's out, Boston's out. You know who the dark horse is? Pittsburgh.
Oh.
So if you're playing along with Redfin, look for clues. I think it's going to be in the Pittsburgh area. So
all right.
So I thought, well, why not? Why not do this? Kind of figure out where this thing
Give me like Lubbock, Texas, somewhere middle of nowhere, like I don't know. I'm leaning Texas.
Are you? Because I was laughing. I'm like, okay, if it's here in Florida, it can't be in Windermere. It's not gonna be in Windermere. Probably won't be in Winter Garden. Nowhere on the coastlines. Yeah, right. Can't be not gonna be on the coastline.
Micanopy.
So I'm like, dang, where could this house be? So I thought, let's decipher a little bit, figure out where it might be. So So my estimate, based on what I put in, I think it's going to be in Pittsburgh.
All right, we'll see.
All right. So,
Pittsburgh.
all right, everyone. Thanks for joining us, and love having you. And we'll see you next week. Please like and subscribe. As always, take care. Have a great day, Joe. Bye-bye.